Do not panic. Everything is just fine. A record amount of people are in a record amount of debt, but there's no reason to worry. The Fed has your back. The men in dark suits in the financial industry who secretly meet with government officials and who have been caught over and over again rigging different markets are there to ensure your investments will remain safe. That sounds realistic, right? You came here for the truth. So let me unveil that for you. Today we are going to talk about debt. There is so much debt today, not just in the United States, but that's where I want to focus my attention. I hope that you will find this interesting. I'm going to give it to you as fast as I possibly can. So let's begin. About 37 million credit card accounts had a 90 plus days delinquent mark added to their credit report last quarter. That's an increase of about 2 million from the fourth quarter of 2017. This has become from excessive to absurd. These 37 million accounts hold roughly $68 billion in debt that is 90 plus days delinquent. You have to put that into perspective. There are 37 million credit cards that are now unpaid. Understand, 3 months plus unpaid. This is not going to get better. It's going to get worse. Where are they going to get the money from? We have already seen housing prices peak and they have started to come down slowly. Certain areas, they're just stagnating. Wages aren't increasing. Where is the money going to come from? I see people, they plant their dollar in the ground and hope that a money tree comes up. That doesn't work. They have tried it, I assure you. They bought the magic beans. That didn't work either. In aggregate, credit card limits rose for the 24th consecutive quarter with a 1.5% increase in the fourth quarter of 2018. I don't know about you, but I get offers all the time. Let us increase your credit. Let us give you this line of credit. How can we give you more credit? They're constantly pushing. In 1 week, I received a letter in the mail. I received a notification when I logged into my banking online. I also got an email. I even had a notification in the app on my phone that was almost impossible to get around. It made it impossible in a way, and then you had to click on something weird, and then it finally allowed me to get into my banking. It was trying to trick me into accepting a line of credit. Regardless, I'm sure you find the same exact thing. They are pushing this on people even when we don't want it. We say no, and somehow we are given more credit. It's ridiculous, but that's the way it is. Older Americans are holding a significant portion of credit card debt, with those over age 60 accounting for about 30% of the total. And this is worrisome because you have individuals today who should be slowing down. They're worried about retirement. They have a whole big 401k there. Their house is all paid off. The car is paid off and things are looking good. That's not the case. They're in so much credit card debt today and they're never going to be able to retire the way things are looking. Once again, I say this every time. Of course, it's wonderful if you can work forever and ever. That's great. However, a lot of people, they don't want to do that. They want to be retiring and they can't do so. Their pension's probably not there or not existent. They don't have the ability to save up for things that happen along the way. Maybe they got sick. Maybe a family member was sick. There's all different types of reasons this could happen. And today, people are finding out the results of this terrible economic situation that people are in. Okay, this is on a grand scale. One possible trouble spot is that by age group, older Americans are seeing that their credit card debt transition into the delinquency category at an increasing pace. In particular, those in their 50s have seen the most rapid change and could be considered the most vulnerable should a change occur in their employment. And guess what? What's around the corner? That's right. We've got some unfortunate events that are due at some point. This economic cycle is extremely long, and unfortunately, that has to come to an end at some point. These people right now, if you're in your 50s, you better watch out. I hope that you've got everything prepared. Americans' net worth fell at the highest level since the financial crisis in the fourth quarter of 2018 as sliding stock market prices ate into the household balance sheet. Now that's interesting, right? You see that information and that tells you a story, but I'm going to tell you another story that connects in with that in just a second. Net worth dropped to 100 trillion as the year came to an end, a decrease of about 3 trillion from the third quarter. Obviously, there's a very good good reason for this. Much of the slide came due to Wall Street's woes as the stock market suffered a precipitous decline that started in October and briefly reached bear market status. This article out of the Wall Street Journal essentially covers the same information. I just wanted to give it to you if you're interested in that. Basically, we're looking at what happened throughout 2018. Stocks were rising for the most part in the first 3 quarters of the year. The last quarter of the year looked terrible, and that's really where we saw the decline coming in their net worth. The data that they are covering in these articles always comes from a report. Now, the way that the mainstream media works is that they never have to show you that report. They never have to actually document it in any way. They never say, here's the sources. But here at the Money GPS, I always show you the documents themselves. And even if I don't show it on the screen, if you go to the sources in the description, it's there. I assure you, I'm always giving the documentation for that which I'm referring to. This is one of the reports, Financial Accounts of the United States, 4th quarter 2018. It's massive. And here's another one, Household Debt and Credit. This is important. This is out of the New York Fed in this one. But in here, there's a lot of detail that gets into, the 37 million and so forth. But I just wanted to show you some examples in a moment. When I show you this here, this is from the Fred website. I'm sure you're all familiar with it. Total consumer credit owned and securitized. I mean, come on, $4 trillion worth. This has gone into territory it can never, ever get back from. Look at what happened during the financial crisis. Just a few hundred, and I say that tongue-in-cheek, a few $100 billion of a contraction. After the financial crisis, the entire economy went into a full stop. If you look at the little blips along the way, that's actually some change in the accounting and it's not an actual decline, okay? The way that they calculate it basically changed at that point, and so it just looks like there's a decline, but actually that's not really the case. Debt has expanded and you consider debt is the new wealth. I'm sorry, that's not the way it works. It's never been that way. You can leverage up, that's fine, but actually going into debt is not beneficial. Sorry, that's not going to be explained in any which way. You can't do that. It's not going to make sense. If you buy a real estate property, an investment property, you put 20% down, people are paying down the mortgage, you got your renters in there, you're making some profit, everything's being paid by the renters, that's a different story. But if you're going out there and you're buying your own home at 5% down, you can barely make the payments, then you take out a home equity line of credit, you buy a new Maserati, you buy the newest iPhone, and you're living the high life. That debt, that's what a lot of this debt is. And it's terrible. You can't create wealth out of that garbage debt. So I'll show you a couple charts here out of that report. Total debt balance and its composition. I've shown you this type of chart before. The New York Fed puts these together. You're looking at mortgages, that's the orange. You also have the green, which is autos, and that's been having a very big problem. Obviously, you've also seen the student loans, which have expanded greatly over the years, and it's only going to get worse. We've seen that over the last little while becoming such a serious problem. Well over $1 trillion, and it's not going to stop anytime soon. Transition into serious delinquency, 90 plus days by loan type. Okay, we have the student loans, which you can see there. But of course, for today, we're looking at credit cards. And what I wanted to note about this is that at this point right here, this is basically when we began to see an increase in the rates that the credit card companies were charging. And is it so convenient that all of a sudden people couldn't pay back? Of course, they are directly correlated. That's credit cards, any form of debt. If you increase the amount of interest that people are paying, you're going to have an increase in the amount of people that can't pay. Okay, it's a very, very straightforward fact. And really quickly, percent of balance 90 plus days delinquent by loan type, whether that's the credit cards, student loans, auto loans, and just take, for example, in terms of percent here, student loans, just what is that, maybe 12%, maybe 11%, somewhere around there. Auto loans is just shy of 5%. That is increasing year over year. We've got a problem right now that is going on with the average individual. Forget about the nation as a whole, forget about the corporations for just a minute, but the average person is so heavily in debt, and all the bad debt, that's where their debt is, that's where the delinquencies are, as you can see here, and it seems to be getting worse. They have been through a 10-year period of booming economic conditions. At least that's what I was told. That's what the mainstream media shows. I can see the stock market is doing oh so well, and yet you still have this. You still have 37 million credit cards that aren't being paid up for 3 months. That's not 1 month. Hey, you missed a payment. It happens. It happens. But you look at 3 months, you've got a serious problem. And of course, this will not be resolved by printing more money, I assure you. And that's their only solution every single time. There's no doubt about it. If you found this video informative, please give me a thumbs up. By giving me a thumbs up, you are supporting this channel. All you have to do is click that like button, and I really do appreciate that. If you want the financial education you weren't taught in school, these 2 books have everything that you need. You can get them at the link in the description. You'll see everything from the foundation, making money, so much more. Check them out at the link if you want the audiobook that's available at themoneygps.com. But hang on just a second. If you haven't watched this video already, you definitely want to do so. I think you'll find it really, really informative. I'll see you there.